Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive in buying at the high.
Investors don't necessarily need international stocks to have a globally diversified portfolio. But you, yesterday at the conference, you talked about Jason Zweig's good piece on the perhaps relative undervaluation of foreign stocks. Do you think investors ought to look at that, be thinking about the fact that we have not seen foreign stocks perform as well as U.S.?
I guess the answer to that is yes and no. Number one, the fact that they're undervalued may mean that they're undervalued because they're riskier, which I think is at least importantly the case, maybe not the entire case. Second, I'm just a great believer in a U.S. portfolio because we're the most entrepreneurial nation. We've got the soundest institutions, financial and otherwise, or have had in the past. Governance is pretty solid, in the past at least, and a well-diversified economy. And for U.S. corporations, about half of their revenues and half of their earnings come from abroad anyway. Mm-hmm. It's not as if we're America first or America only. The entire world economy is integrated around many, many countries trading with many, many other countries. So I do not think you need to have international. Now, people have been doing it for a long time. The cash flows in the fund business have been much stronger in non-U.S.
international, yeah,
than in the U.S., despite the inferior performance. And I don't quite understand where this thing is that you must have a global portfolio. Maybe it's right, of course, maybe anything's right. But I think the argument favors the domestic U.S. portfolio. And then you have to worry about whether the dollar is strong or weak.
Right.
One more risk. Or many of these foreign nations have, particularly emerging market nations, which are, I think, around 20% of the non-U.S. index, are very risky, very interest rate sensitive, governmentally not strong, or maybe a little capable of tipping over rather easily. So I do tell people, feel free to disagree with me because I'm not always right. But if you, I have 0% in non-U.S. I say you don't need to have non-U.S. But if you do, limit it to 20%. A lot of portfolios now have 25, 35, 45% in non-U.S. securities. And I think that's just too much. Inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument, and let's say over 10 years. But that instrument's going to lose 30% of its value conservatively over the next 10 years. They'll have a little bit of interest to offset that. But if the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has, and I don't think in our lifetimes it ever will. Maybe sometime, But so there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2% and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years, gross, before cost, before anything. So that's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5. So if you think about inflation, if there's 2.5% inflation and the bond gives you 2.5%, you're doing a break-even investment over the next 10 years. And that's just, you need more than that if you're going to build a retirement fund.
And if you have X dollars and you're getting 0%, and you, even if you're living frugally, you're still reducing the purchasing power, the actual amount of money that you have.
Yeah, and importantly, we live in in a way, and I've said this before, in the most difficult time to invest that I've ever seen. And the reason for that is, yes, stocks have more volatility risk. They go up and down, and bonds stay pretty steady from day to day. But you have to take into account not only the risk, but the return. And the return on stocks, I think, is, I'm close to saying destined to, but I won't go that far. I'll say highly likely with a 7% expectation, which could be right or wrong, but it's certainly very likely to be to 2.5%, almost certainty, for bonds. And actually, I'm being generous to bonds, because the government bond, the 10-year Treasury, is yielding 1.6% today is all. So you got to take a little bit of risk in corporates, and I would frankly take a bigger risk in corporates. But so ask yourself this question: which is riskier for the next 10 years? That bond, which will give you a low return, but probably not very much, or the stocks, which are highly likely to give you a high return, but with volatility along the way. And for that reason, I like the idea of a balanced portfolio, some stocks and some bonds, although you have to think about it a little bit differently today with interest rates at these floor price. Money market funds are basically not even worth buying. The average yield of a money market fund is, I think, 0.2%. People should buy very short-term bond funds, my opinion, high quality, short-term bond funds instead. So there are ways to do it, but you have to look at just not volatility risk, but the entire picture of investment risk to dividend income, risk to your income. If you're giving up a 2.5%, 2% stock yield and getting only 1% from a CD or whatever it might be. Goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance, because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year, cumulatively, against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. When, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. Buy right means diversify, diversify, diversify. In an index fund, which is a great way to invest for reasons I've talked about earlier, you at low cost and all that. but you're diversified, so the intricate ins and outs of the market, you know, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that. So, but that's the buy right, very diversified, and the hold tight is what we've talked a little bit about, and that is, you know, when you get these periods of adversity and fear and greed, don't do